All right. Hello, everybody. Welcome to my channel, the channel where I analyze stocks that are interesting. So, if that interests you, then please consider liking this video, subscribing to my channel, leaving me a comment below, interacting, and make sure that you follow me on Seeking Alpha, where I post in-depth analysis. Um, the videos on this channel, they might be anywhere from 20 to 40 minutes long at times. Honestly, I spend more time writing the articles on each of these stocks. And frankly, my ideas are probably a little bit better articulated than they are here. The reason for that being, the reason for that being that I sometimes forget certain things about the investment case for some of these stocks that I think is important to cover, whether that be positives or negatives. So please be sure to follow me on Seeking Alpha. I'll put the link in the description below. But anyhow, without any further ado, let's get into it. Today, I'm going to be talking to you about a company called Flowers Foods, ticker FLO. Okay, Flowers Foods. Um, Small cap company, $4.2 billion market cap, 420. $4.2 billion market cap. Super interesting. As always, I'm going to go into the some of the background on the company, who they are, what they do, what they sell. Does the company have a moat? Is there a narrative driving the stock price? I'll also do an analysis of the financials. Uh, we'll take a look at the valuation. We'll take a look at the dividend metrics. We'll discuss the risks and we'll give it a grade: buy, sell, or hold, as well as do some technical analysis of the chart. Now, as always, do your own research. This is not a recommendation to buy or sell a security. It is merely my opinion, educated opinion. So, anyways, today we're talking about Flowers Foods. What is Flowers Foods? Okay, well, it's a consumer staples company headquartered in Georgia. Flower Foods Inc. produces and markets packaged bakery food products in the United States. It is a United States only target market company. Interesting. Most of the companies that I cover, they have some level of international sales and therefore some level of currency risk. This has none. Depending on your philosophy, that may or may not be a good or bad thing. Um, they actually have a lot of brands that you might recognize, such as Nature's Own, Dave's Killer Bread. I don't know about you guys, but I love Dave's Killer Bread. All right. Dave's Killer Bread, Wonder Bread, Canyon Bakehouse, Mrs. Freshly's, and Tasty Cake. Brand names. This is their website. Nature's Own, Dave's Killer Bread. That's a big one. Wonder Bread, big brand. And then some of these other brands here, admittedly, I don't I'm not too familiar with some of these other brands. It does appear, see this font and brand style on Nature's Own. It looks almost identical to this and this. So here's the deal. 45 bakeries across 19 states, 9,300 employees, 5.1 billion in 2023 sales, and the number 2 in U.S. packaged bakery foods. As for what is the number 1 company, I'm not sure. I'm really not sure. I would guess that it might be General Mills or something like that. So pretty interesting, right? Number 2 in U.S. packaged bakery foods. This isn't a insignificant player. They're just kind of a small company. It kind of implies that the market size of baked goods and bakery products really isn't that big, which is a little surprising. My family, we buy bread every single month. Every couple weeks, we buy bread. Um, I would imagine that most people, even people who are gluten free, do regularly buy baked good products. I'm a little surprised at uh, the fact that this company is only a $4 billion and it's the number two. Um, I'm not looking at the data, but I find that very interesting. So, does this company have a moat? Well, it seems like they might. They probably should, right? If they, like other consumer staples, packaged food products, very simple to understand. Packaged food products carry, they have moaty attributes and moaty qualities. I will say, maybe I'm personally biased here. Dave's Killer Bread is the best bread in my that I've had, in my opinion. It's not white bread. I do like wheat bread. Given a choice between Dave's Killer Bread and virtually any other bread, I will choose Dave's Killer Bread. I think it is superior. So there is some brand equity there, right? So pretty simple to understand that a company like this, just like other companies I've covered, McCormick, you have Hershey, many others that I will cover in the future. Yes, some of these brands have very moaty attributes. So there's intangible brand assets creating a moat around some of these products. Um, Pretty sexy, right? So, what about the performance of the stock? Has not performed well. We see here, it a stock like this, it's not sexy, it's not fast growing, it's not AI, it's not technology, it's not going to have volatile price swings. What I would expect to see is that it's less volatile than the market. You do see that here. Um, it did not draw down as much in this period. It outperformed the market and then underperforms in the bull phase here, outperforms in the bear phase of the market here, underperforms here in the next bull phase. In fact, not only does it underperform, but it's kind of selling off. So what's driving the fact that this stock is performing poorly right now? It's all food stocks are performing very, very poorly. Um, these peers here, I'm not sure. I'm just going to stick with what I know. We're going to pull up some of the usual suspects here just to give an idea of what I'm talking about. Pepsi, Hershey, McKesson. Company that's somewhat similar to Flowers, but a lot larger, Mondelez. Okay. So every single one of these stocks has underperformed the market and exhibited somewhat similar behavior from this period. Most of these stocks did outperform here. All of them underperformed here. Again, the light blue is the S&P 500 here. Here's Flowers Foods. Here's Pepsi. Again, it's just more flat, right? Hershey, a little bit more volatile. A little bit more volatile. Really outperformed during the bear market. McCormick has performed the worst. Mondelez, look at that. Just flat. Just very flat. Hershey has still performed the best. So here's the thing. Flowers Foods. Notice how each of these stocks, maybe with the Hershey probably has the most beta. It's the most volatile of any of these. You see how these stocks are correlated with each other somewhat. They've all traded somewhat flat to varying degrees um, over the last. This is the 5-year chart. So what's driving the price, for better or worse? It's because we're coming out, or we're at the tail end of an elevated inflationary environment. And here's the thing: is these companies, they, depending on how long inflation lasts, right? They're susceptible. Companies that sell food, they're susceptible to input inflation. They can pass those costs onto consumers to an extent. The bigger moat that they have, the more they can pass through, and the more that they can drive sales growth. You see that with Hershey's stock price here. Again, this is the inflationary period right here. Hershey was a beast during that time period. It's also been one of the worst performing stocks over the last several years in this group. Anyways, so what we're looking at here is food staples companies. They're not cyclical. They're not actually. They're very stable in terms of sales, earnings, whatnot. But they're susceptible to commodity inflation as an input, and their success is predicated on how much of those costs they can pass through at the same margins to consumers. So it is conceivable to think that at the tail end of an inflationary spike, that food producer companies would um, see margin pressure, see their stock prices come down due to stagnating sales growth. That's exactly what we're seeing. New bull phase kind of started right here. Every single one of these companies is underperformed. I actually really like the consumer staples sector. It's one of my favorite ideas right now. Um, it doesn't mean that more volatility isn't ahead. So, full disclosure, I do have shares in every single one of these companies except for Mondelez. Okay. But every other company I do, the largest position is Hershey. So, there's negative sentiment surrounding this stock right now, which means that it might be trading at a value. Um, it might, but it's probably not going to outperform the market in the immediate term. One thing I do want to highlight before we move on to doing an analysis of the um, financials is just to take a look at the long-term chart here. Look at how stable this stock has traded since 2001. Again, this is very, very simplified analysis, okay? This is not sophisticated, but just very, very crude technical analysis here. Look at how consistent this stock has been. Every time it touches down on this trend line here. In fact, maybe we should look at the candlestick chart. And normally we don't look at the candlestick chart until the end. This is kind of a crude line here. So we're going to come back to that. So you have this kind of aberrational period here. Okay. What happened in 2013? Well, they bought in 2013. The company purchased most of the bread brands of Hostess Brands, including Wonder Bread, plus closed 20 Hostess bakeries. So that was a major acquisition. I don't think Wonder Bread has a significant market share anymore, but I know at one point in time it might have. I mean, maybe we should look this up. Market share of Wonder Bread, 20 to 30%. Although it's not as popular as it once was, Wonder Bread is still a profitable part and has gained some market share. Okay, that wasn't quite the smoking gun I wanted it to be. You have this aberration here where the stock significantly outperforms from the trend line. In fact, it basically doubled. It almost doubled. $13 a share, something 13 something to 27. So it basically doubled in a period of 3 years. And then it came right back down to earth, right back down to $14 a share. But for the most part, really since 2001, the stock has just traded super cleanly in these two different trend lines here until recently broke back down into uncharted territory. So it has not been the price it is now since the COVID crash. Since March, April 2020 was the last time it was this cheap or this price. Rarely does this stock exhibit this behavior. And when it does tend to form a new base. You see here, it broke through right here before cleanly finding a new base and just resuming its uptrend, right? So I just wanted to highlight that. This is a very predictable looking chart. It doesn't indicate that it will continue to be so in the future. However, I really like the way that looks. It's not It's not as volatile as the broader market. But I mean, gosh, if you look at this, if you would have bought this stock 10 years ago, this is just the price return. Let's at least make sure to look at total return. If you would have bought this 10 years ago, you would have drastically underperformed. However, the benefit of buying a company like this is twofold. Okay. It's very stable. It's a plotter, plods along very slowly, low beta. In other words, it, in theory, should lower the risk of your investment portfolio. Therefore, it makes sense for me to invest in assets that are lower beta, that have a strong yield like this, to allow me to afford my carrying costs of leveraged investments and to keep the value, the NAV more stable. So, is it a good deal right now? I mean, it certainly looks like a good deal, just chart wise, but is it actually a good price? Let's look at the financials. Okay. And the last few articles I've written, I've realized I've really glossed over a lot of important things here when it comes to the chart. I'm not going to do that this time. Okay. Or I'm going to try to be a little bit more slow and careful with my evaluation of this. So, again, we always go back over the last 10 periods, back to 2015 is what that is now. Okay. So from 3.8 billion to 5.1 billion, that's roughly 30%. 30% growth in top line. What about gross profit? 1.8 to 2.5. I need a calculator. Normally I do this in my head, but I'm struggling today. I don't know why. 2,524 divided by 1,798. That's 40%. We might as well do the top line here. 3,749. Okay, 36% growth in top line, 40% growth in gross profit. Good. Operating income, 24% growth in operating income. So here's the deal. Gross profit expanding quicker than revenues means that gross margins are going up. Good thing. Operating income not going up as quickly as gross profit, not as good. What's the culprit for that? But again, we're not looking at their official company provided financials, which may be more granular than this. What we are looking at, we have these categories here. We have SG&A went up from, let's do the math, 1.4 billion. Okay, SG&A went up by 46%. So again, we don't see the granularity of what's included in that line item. However, what I would hope is that the marketing budget is expanding faster than gross profits. So regardless of the actual momentum of each of these line items, we are still seeing growing revenues, growing gross profits, growing operating income. This piece does beg further questions. It does not really concern me too much. However, for those who are more interested in figuring out the reason why operating income is not growing as fast as gross profit, you might be able to tell by looking at their financials. I'm not going to do that for the sake of time, mainly because it does not concern me that much. It's not a demerit on the company. It's just more of a Let's take a look at some other things here. Diluted shares outstanding. The share count went up by 2 million, by 1 million. The weighted average shares outstanding on a diluted basis has very, very slightly gone down. Okay, so they're not buying back shares really. Another thing that sticks out here, revenue per share, 24.26. 1994. So the price per sales ratio of this company is less than 1. That's cheap. That's good. Here's what's not good that sticks out. Diluted earnings per share from 82 cents a share to $1.14. Okay, that actually does pretty much match operating income, except it does appear that interest kind of weighed into that. We'll take a look at the balance sheet in a moment. Earnings per share, I don't really like what I'm seeing. It's not really growing that much. We're not seeing strong net margins. Their gross margin profile looks good. The net margin profile, something's going on there. It doesn't concern me. Again, I already own shares in this company. It's a small position within my portfolio because I think it's at a good price. It's a good value. There's a reason that it's trading at the valuation it's at. I mean, even just look at the payout ratio, very, very normal in a given year for the company to pay out at least 60%, if not 80%. Okay. Just a boring, slow growing company here. Let's take a look at the balance sheet. Cash and cash equivalents, 15 million in the last report. That is a very, very small amount of cash. They've got 2.8 billion of equipment. So they might have real estate in there, manufacturing equipment, stuff like that. Real assets. Normally, there's lots of asset items that are kind of just fake assets, or intangible assets. I I kind of like taking a look from when I think about it, taking a look at gross property, plant, and equipment and comparing that to the market cap. Sometimes, depending on what type of company it is, if the company is trading at a lower than book value and they have a lot of property, plant, and equipment, that looks like a really strong value sometimes. That's not the case here, but it's not too far off. Again, remember, $4.2 billion market cap. And I don't, I add back accumulated depreciation into that, by the way. 1 billion of long-term debt versus 15 million of cash. So they do not keep a lot of cash on hand. There was kind of a 3-year period where they had several hundred million that they were flush with. The reasons for that, I'm not sure. Maybe they sold a brand. Not sure. I won't care to investigate right now because it's not super relevant. The idea being they have honestly not that strong of a balance sheet. Again, $1 billion of debt, long-term debt, $2 billion of liabilities, total liabilities. And that all looks fine. Retained earnings has been going up, which is good. Not a very strong balance sheet. I would hope and prefer a company to have a little bit more cash on hand, but the fact that they don't have much cash on hand is indicative of the strong cash generative nature and the stability of their business. Why do they not have a lot of cash? What have they been doing with their cash? They haven't been buying back shares. Well, it's those dividends they've been paying out. They've been paying out those dividends and making acquisitions. In fact, they just announced an acquisition. We will discuss that in a moment. You see here shares outstanding. It's about the same. Yeah, here we go. Cash per share, 7 cents of cash per share. Let's just quantify that for a second. This is important for investors who are counting on dividends to think about. Our dividend per share is 94 cents. They have 7 cents of cash on hand. think it's important that we think about just how leveraged some of these companies are and how that has to do with their underperformance. When interest rates are going up, I think it's easy and simple to say, oh, this company has such a strong dividend, it's going to do well. But what about the fact that they don't have a lot of cash, continuing to make acquisitions? They have to borrow or issue shares to do it. I know that because I've read these reports and we will too. Um, Rising interest rates are more impactful for companies that have very low cash on their balance sheet. Uh, so I don't love the balance sheet. I just don't like it. I want it to have a little bit more liquidity, and they might have some sort of revolver or something. Let's talk about the valuation. Um, Valuation is good. Seeking Alpha gives it a B. The price earnings ratio, 15 to 17, that's pretty low for a company that has Modi qualities like this. It's pretty low. Price earnings growth on a trailing basis, very, very low. It doesn't make sense to look at the price earnings ratio trailing 12 anyways. On a forward basis, it's expensive. It's not growing fast. Here's what I like. Price to sales is less than 1. Pretty rare to see a company like this trade at a lower than 1 price to sales ratio. Usually when you see, like, what are companies that trade at very low price to sales ratios? Companies with phenomenally low margins, like the medical distributors, like McKesson, um, Cardinal Health. Those companies, they all trade at super low price sales. But food companies like this, they usually don't trade under 1. In fact, you see here the sector median over 1. In fact, the 5-year average over 1. Um, in fact, by all of these measures, the company is cheaper than the 5-year average significantly. So, on a relative basis, the valuation looks really good. Let's talk about the yield based valuation. Look at this. The company is trading at the highest dividend yield seen within the last 10 years. And that trend, it was very stable, kind of hovering around this low 3% band, and it's just skyrocketed. I mean, we're almost at 5% now, 4.76%. That's higher than the 10-year treasury, folks. Not many stocks trading above the 10-year treasury right now. And this has been a dividend compounding machine. If you would have bought it 30 years ago, your yield on cost would be 60%. Free cash flow yield on a forward basis estimated 6.7%. That's pretty good. That's pretty good. Let's look at dividend growth. I like to look at it like this. Okay, so going back to really as long as we can see, starting in 2017, the company has raised their dividend by 1 cent a share per year, 16 to 17, 17 to 18, 18 to 19, 20, 21, 22. So doesn't take a PhD in math to know that that means that growth has been slowing down over that time frame. However, what does that actually amount to? You see here the compound annual growth rate right now in the mid 4%. Seeking Alpha is estimating that we're going to compound the dividend over the next 3 years at 3.3%. And that the raise is going to be 4.6%. That is higher than inflation, at least this. Inflation's high 2s, low 3s right now. If we do the chowder number of the stock, again, the yield is 4.76%. If we are growing the dividend at 4.6? 4.6 plus 4.7 is 9.3% return or chowder number. Not bad, guys. Not bad. Obviously, if you buy Visa stock or whatever, it's like less than 1% yield, growing at double digits. The chowder number is double digits. However, this stock looks to me to be a good deal. Now, there are the balance sheet isn't good. I would argue that that might be a reason why it hasn't performed well, along with the narrative driving the price. Okay, so there's those two things, but it looks like a good value. Let's just look at the price earnings ratio over time. This chart is very volatile looking, like here included. It's basically where it has been. This is a stock, because it is a smaller cap. It doesn't appear to be subject to the same animal spirits that a lot of the mega cap stocks are, which I like. It's just a boring, unsexy, slow growing stock. Before we talk about some of the risks, I do want to just take a look at their most recent earnings report, as we always do. Generated category leading market share gains as each of our primary bread brands grew in tracked channels. Narrowed guidance to reflect greater certainty as we enter the fourth quarter. So year over year in the same quarter, we had a contraction in sales. Here's what's good: 10% growth in adjusted EBITDA, just above 10% margin. So adjusted EBITDA increased primarily due to lower ingredient costs and distributor distribution fees, partially. Again, this is a stock that is growing slower than probably even the average S&P 500 stock, right? Your share price appreciation should be lower. However, the yield is higher than the risk-free asset, the 10-year treasury, and it is reasonable to expect that it will grow. I like those odds, okay? Net sales came down. You see here, 283 million cash from operations, 152 million in dividends. The remainder, a lot of the remainder spent on CapEx. Net income up versus a loss in the prior year. Adjusted EBITDA up 10%. Higher gross margins, partly offset by higher adjusted SD&A expenses. We saw that in their numbers. Just kind of a mixed bag of results. Ability to mitigate cost inflation. So here's their guidance for the fiscal year ahead. So they're saying for the year ahead, 1.24 to 1.28. That's like 1 point something percent to 3%. Very low growth. Basically growing at inflation. Long-term growth target scorecard. Long-term targets, they aim to grow sales by 1 to 2% per year, adjusted EBITDA 4 to 6% per year, adjusted diluted earnings per share 7 to 9% per year. Look at these growths coming out of COVID. These look more normal. Sales is growing quicker in every single period. Sales has grown quicker. EBITDA has grown in line or at the low end. Earnings per share is in the last 2 fiscal years below their growth target. They don't appear to have strong operating efficiency relative to some of the other stocks I've looked at. The most recent stock I did was Parker Hannifin, completely different sector type of company, much stronger looking operational efficiency. Private label momentum fading, change in private label unit share. They're losing unit share. Private label meaning, I believe, they're basically like an OEM. They're making bread under a store brand. Branded retail benefiting from stronger bread performance, more than offset by cake soft. Volumes are down across the board. Long-term trend of branded share gains interrupted by inflationary pressure. I feel like I have to look at that graph for a long time to understand what it means, but it doesn't look very good. This makes more sense. Flour's market share. Flour's bread dollar share. Dollar share just must mean exactly what market share should mean. Sale, like percentage of company sales over percentage of industry sales. So we've seen fairly steady growth in bread dollar share, declining cake dollar share, although that's less important. Flowers fresh packaged breads, unit sales up in the last 2 quarters. This is an interesting graph because it does kind of belie the point that costs were passed through in the inflationary phase. Consumers bought less units. They're still going up, albeit much slower, and unit growth is resumed in the last few quarters. That actually looks like a pretty positive chart to me. Cakes are not doing well. I'm not much of a sweet tooth, so I'm not going out of my way to buy cake. I guess I'll say that. Organic category. So they're growing market share significantly in organics like that. It did tail off in the last period. Gluten-free category. Man, they've grown quite a bit. That's sexy. Here's the deal, guys. Very uninspiring financial performance. This is a cheap value-based investment. I think it's at a good price. Will it outperform the market from here? Probably not. But I am an income focused investor primarily. So my largest portfolio, I have my retirement accounts, but in my taxable account, I have an income based strategy. And the rule there is that the yield on that portfolio must exceed the 10-year treasury. So there must be a yield premium on the risk free asset, and every position must have a yield. That's the only rules. So, of course, what that ties me to is it forces me to find companies that might be like this, where the income return will surpass that of the index. The S&P 500 has grown dividends by 4% in the last 5 years or whatever, like pretty in line with what this has done. But the yield on this investment is like 350 basis points higher to start. So again, I'm really only measuring my performance in terms of income and income growth on a weighted pure dollar basis. Now, in terms of a total return basis, I did outperform the S&P 500 last year. I do not assume that I will do that every single year, given the way that I've oriented my strategy. So let's talk about the grade. Normally, I talk about the risks before I talk about the grade. Well, I'll talk about the risks. What are the risks here? It's US only. That's a strength and a risk. So we are exposed solely to the United States customer. We're exposed solely to the dollar. All of our sales are in dollars. Is that a risk? Is it a contra risk? It depends on who you ask. I personally think that the United States right now is the place to be. There's a lot of volatility in markets around the world, a lot of currency risk. The other currencies of the world are relatively weak compared to the dollar right now. So having your sales be in dollars primarily, there is an advantage to that. What are risks of this investment? They carry a lot of debt. Their balance sheet is not strong. And then you have the fact that they are susceptible to shifting consumer preference. You see how people's attitudes towards bread have changed over time. Just look at the fact that they're buying, or they have bought and expanded this portfolio of gluten-free products over the last few years and have a significant market share in that. Management does appear to be cognizant and smart in terms of how they're allocating that capital. However, shifting consumer preferences, I would argue, are more significant in this bread segment than they are in like the confectionery segment with Hershey, because there's always a place for a candy bar. Like innovation is probably more likely to occur in something like a bread than it is in a candy. But I can't quantify that, and neither can you. So I would just say that the main risk here is the way that the company is deciding to allocate the capital towards the dividend. I actually think it makes sense for the company to not grow the dividend from here. Again, when your dividend rate is above the rate of the 10-year treasury, Should investors be okay buying that yield if it doesn't increase for a few years and they're being compensated above what they would in bonds, with the expectation that it might grow in the future if you were to deleverage? Perhaps. So I do think that that is a risk as well. Is they do seem to be very aggressive in their shareholder return in the form of dividend strategy, which obviously, given my investment objectives, is, I'll benefit from having those yields flow back through my portfolio. However, this company is never going to be a substantial position in my portfolio because it's a good component, but it's not the star of the show. Before we talk about the grade, I do want to talk about this real quick. While we were talking about debt, while we were talking about new product categories, this was announced yesterday. The company snapped up Simple Mills. Simple Mills. I think I've tried these products here. They're pretty good. This almond flour cracker. They have like these healthy Cheez-It equivalents here. I did see these for sale at Sprouts the other day. I did not buy them. I have a peanut allergy, or they're pretty good. What's the theme here that we're looking at? Just kind of more of a like healthy oriented branding here. So Flowers just announced that they're purchasing this company for $795 million in cash. We know that they don't have that much cash. So that must mean that they're borrowing to do that. Well, of course, they entered into a binding commitment letter for a $795 million term loan from Royal Bank of Canada to help fund the. It's basically completely leveraged. Here's what's interesting. Simple Mills estimated to have generated 240 million sales last year, representing 14% growth. Total net debt estimated at the closing date will be approximately 1.9 billion. The pro forma total net debt to EBITDA ratio expected to be 3.1 to 3.3. Net sales of 5.1 billion in 2023. That is roughly 5%. So in other words, that grows their sales by 5% overnight. So this is what I was looking for right here. During a conference call, Flowers management noted that Simple Mills has seen sales grow at a 28% compound annual growth rate from 2019 to 24. Deal was called more of a growth play than a synergy play. The deal is being seen immediately accretive to net sales and adjusted EBITDA growth and adjusted EBITDA margins. Hopefully it works out. If it does work out, then the stock has gone down the last couple months since November. If they integrate that acquisition successfully, it will immediately accrete to their financials. It's not in the quarterly guidance we looked at. So if they integrate it successfully, they're going to obviously exceed their guidance. Now, everybody's going to know why, but it's going to look really good in their numbers and it'll probably, be positive for the stock price. Just a side note, the Seeking Alpha Quant rating has it as a buy. I agree that it's a buy. That's the grade I give it. It's not a strong buy. This isn't one of those things that I feel like you put a lot of your money into. I feel like it's a fairly safe investment. Again, their balance sheet is not strong. However, they do have strong brands and they have exposure to a couple of good end markets within the, bread segment, which I really like. And their acquisition of Simple Mills, again, that pushes growth. It's somewhat diversified from some of their other products, right? It's crackers and snacks, and it's not bread, right? So I like the acquisition a lot. I really like the acquisition a lot, and I really like the growth numbers that we're seeing from that. So I like the acquisition. I like the valuation. I like the yield. There's a few things that I want to see different about the company. However, they are not an impediment from me buying. There really isn't much negative going on with the stock. It's just not growing very quickly. And it's kind of a victim of some of the negative sentiment going on around food stocks right now. RFK Jr. is driving that. The inflation, the tail end of inflation is driving that. I think that it's mispriced. Now, is it severely mispriced? I don't know. I mean, really, I think it's probably fair for it to be trading closer to 20 times earnings, like some of these other food stocks are. Earlier in the video, I had the chart of all those stocks. Most of those stocks are trading at or slightly below 20 times earnings. I don't see why this stock shouldn't be 17, 18, 19 times earnings right now. I just think it's smaller and it doesn't benefit from the same brand recognition that these other stocks do. Okay, before we run out of time, let's do technical analysis. We'll keep this really simple. We already drew on the chart. It's just fallen right through the floor. Not only did it fall through this trend line, it looked like it was recovering, but that was kind of a bear. That was kind of a bear trap here. It's bounced off this line and come down. This is a good time to buy it, I think. There's no confirmation here. There's no new base forming. So I think if you are buying it here, you don't expect the price to jump back up. I mean, this is a risky game investing in stocks, right? If you're entering into position here, you have to be willing to be down on your position almost immediately. But I think the valuations, I think the valuation's fair, and I think that sooner than later it will form a new base. Now, if it breaks out again into a new trend, then it might be fair to say that it's a strong buy at that rate. But until that time, I don't know. Interesting company, right? Small cap gem for dividend investors, for value investors. But yeah, if you're in an accumulation phase like I am, again, I have an income based strategy, but the reason for that is I need income. I run a business. The profits from that are up and down. It makes sense for me to go down the risk curve when it comes to equity and debt investments and invest in more income than growth, um, more often than not. So this investment fits my portfolio style well. If you're a growth investor, it might not, but I do believe that this stock will lower the volatility of really pretty much any uh, portfolio that it's added to, just given its trading behavior. It's just a very boring, slow growing stock that's trading at a not only a fair valuation, but a good valuation. But yeah, it's not going to blow your socks off with these crazy returns, and it definitely has not performed well lately. But I graded a buy, and I have already bought some of it. I think it was somewhere up here, recently, a very small amount entered into a position, and I might consider buying more. But yeah, I think it's for income investors. Why not take a flyer on this? It has interesting growth prospects with some of the acquisitions it's making. Hopefully, at some point, they decide to deleverage somewhat. But I like it. I like this stock. I think it flies under the radar, and hopefully, you've found this video interesting and useful. So, if you have, please consider liking this video, subscribing to my channel. Please follow me on Seeking Alpha. I will be writing an article about this that might be more detailed than this video with more well articulated thoughts. So be sure to follow me on there. Get a pro subscription, read the article when it comes out. And as always, feel free to comment on my video. Tell me how I'm doing. Would love to interact with you. And yeah, I'm just going to keep these coming. I derive a lot of joy from doing this. I find it interesting and it's a passion of mine. So hopefully you found it useful. And until next time, I will see you soon. All right. Bye. Thank you.